Hello fellow traders everywhere, Adam Hewison here, co-founder of MarketClub with your weekend update for the trading week ending 9/16. We're on my home page, as you can see. It's September 17th, it's 11:30 in the morning Saturday. Big move in the Dow, the NASDAQ, and the S&P for the week. Actually, the S&P was up over 5%. The battle between the bulls and the bears continues in the equity markets. The past week, the bulls won with a very resounding 5.35% gain in the S&P 500. Out of the 6 markets we track, only 2 closed with positive gains for the week, and they were the S&P 500 Index and crude oil. Both of these markets we consider to be counter-trend rallies. Silver and gold lost ground for the week, with silver closing down 1.89% and gold dropping just a little over 2%. Again, counter-trend rallies in my opinion. The dollar index saw some profit taken and closed down 0.85% for the week. That still looks positive to us longer term. And the Reuters Jefferies CRB Index came under pressure, down 1.38%. And that was in line with the trend. Now let's take a look at the markets and see how we can preserve and grow your capital in 2011. So let's go to our portfolio manager. And it's easy to do. And we're going to go to the first market, which is the S&P 500. And I've already I've already put a weekly chart on because I want you to see this, because here's what I'm seeing in this market. We are, if you look at our trade triangles, we're basically negative on the monthly. This is the most important trend for me, because if you look at the monthly back here in, looks like September 17th, we had a big, this is September 17th last year, 2010. That's when the bull market started again. We had a nice big move up, and here it is. It is August 2nd. We had a signal to basically that the market was going down, and it correctly forecast that. Now, what we're seeing now, I think, is a counter-trend rally, very similar to this week and this week here. This is obviously this is a much bigger one, but here's the other thing I want to show you with our telestrator. I'm just going to put this on the screen to share this with you, and that is we came down pretty hard, like right here. And now we've had this sort of movement like this. And the interesting thing is the Fibonacci retracement, which I'll show you in just a moment, comes in right around where the resistance was, the support rather, which now should be resistance, just right around those levels there. So again, right around the 1250 to 1259 level, the top of this flag, I think it's going to present an excellent opportunity either to exit any long positions you have or to go short, because I think eventually we'll see this market come down and go down to the 950 area, which is quite a big move from here. So again, we're still not out of the woods yet, in my opinion. This is a longer term trend, which we just started, and it looks, we've seen this market, what it's doing here, what it has done is roll over to the downside. That is not a good sign. And there's a lot of work above this market now, and the next level of really important support in my mind is this level right here. That's going to be around the 1050 area. So let's see how that plays out, but nonetheless, in fact, I'll tell you what it was, 1010. So 1000 even is probably a target zone, a big number. So let's just write that in right now. So our TZ, our target zone, is 1000. Now, I'm sure there aren't too many people saying this after this big rally last week, but that's what we're saying, because the trend is your friend, and the long-term trend continues to be down in this market. So let me clear this off the screen, because I want to show you something else in this market. So pretty easy to do, and we go there. And I want to show you this in terms of, I'll scope this in a little closer so you get a better idea. So here we are. I'll move my monthlies out here. And here's our Fibonacci. You've seen me use this before. I'm going to go from this level right here, it's the last high, down to here. And remember the numbers we were talking about? 1228 is a 50% retracement. That's, I think that'll be some problems. Also, it's also the high that we saw here right around 1230. So that could be an area of resistance. I expect it will be. But if we punch through there, the next level of resistance is 1259 based on the Fibonacci. It also ties in with the previous lows on the daily charts and weekly charts. So I think that's an area to look at. So again, that's the zone. We are probably going to get into an overbought condition, or at least get up a little bit higher now. But nonetheless, the trend continues down, and we're expecting this market to once again roll over in that flag formation and head lower. So let's clear the screen. Go to our next market, which is going to be silver. Silver actually closed down for the week, but look at this market. If you scope this out just a little bit, this is year to date, and you can see really since May, since we made the highs in, looks like in April, late April, 24th, the week of the 24th, we sort of gone nowhere. And this is either be one or two things. I think the secondary potentially what it could be, and that is we could be seeing what we consider to be an energy base, where the market's basically just biding times. Whoops, take that off. I don't need that. But the market's just sort of binding time right here, and to go higher. So again, we're above the PSAR. The PSAR, which is this indicator right here, you'll see as you move it, you can see how it changes the values. But we're above that. The monthly and weekly trade triangles are still positive right here, indicating this market can go higher. So I would say this week, I should say last week, the week ending the 16th, may have been the low for silver for a while, and we may see another pop up. Certainly if we go over these highs, over these levels, then I think we'll have a good chance to take out the highs that we've seen here. And that's going to be somewhere around the 49.68, so we'll see $50 silver. So still not bearish on this market yet. There's no clues to say it is going lower, but certainly one has to pay attention to the markets themselves and the trade triangles. So let me take this off the screen, go to the next market, and the next market is going to be gold. Gold is obviously gets a lot of press, a lot of people are talking about that, and gold actually lost ground last week, but it actually rallied from a very important element. Now the area it rallied from was the 1750 area, and that we've been talking about as support, and of course this is the 1750 area. We've also got a PSAR there, right around the, it comes in right around the 1746. So 1746 to 1750 is key area. The gold market must hold this area, in my opinion, to stay viable and not turn our intermediate term trends down. Longer term, we're still positive. We've been long this market, obviously from the 1430 area, which is obviously some $400 lower. And I think we may see some more consolidation, but I think eventually we'll have one more big push up, which is going to take this market probably to the 2100. Let's be conservative, the 2000 to $2100 an ounce level. Again, that's what we're seeing potentially on the upside. I don't know what's going to be the catalyst. Sometimes these things come out of left field, but generally that you have to trade with the trends, and the trends certainly are on the positive side for the gold market. Let's clear this off the screen, go to our next market. All the markets we track, by the way, are basically interconnected, and that's why we track them, because they're all interconnected. Next market is going to be the crude oil market. And again, look at the pattern here. Let's get me a little bit more. Here's the pattern we've been seeing in crude oil. And let me get my telestrator back on, and I share this with you. This is what I've been looking at anyway. So we had the move down, let's say right here, then we had this sort of like little boom like this, like that's a pennant. Then we come down again. This is a flag formation. We've come down again, and this is another potential flag formation. So all of these formations are not bullish. They're continuation patterns to the downside. Now, how low can crude oil go? That is something that no one knows at this point in time. I think if you had said to someone back here when it was $115 or when it was $146 a couple of years ago, it would be trading for about $80 or $85 a barrel. They'd say you're crazy. So things change. You have to be able to change and be flexible with the market. Again, this is why we use our trade triangles. Now look at our trade triangles, our monthly trade triangles. They're pointing down. Our dailies are pointing down. Only the weeklies trade triangles are pointing up, meaning you've got a mixed picture. It's 55. And with 55 plus 55, that is what we consider to be a trading range. And you want to use the tools we talked about every day, which is the Donchian trading channels and the Williams percent R. So that's what we're looking at. So it's a trading range, and that's how we would see this market, but more of a negative bias. That's the point. We're basically in trading range. Watch the lows here. The important level to watch right here this week is going to be the 83.20 level. If we close below 83.20 in this market, it's going to be a continuation to make new lows and maybe test the 75 level or even go the $70 a barrel level, which would be unbelievable. So let's clear the screen, go to our next market. And as I say, these are all interrelated. If the stock market goes to 1,000 on the S&P 500, you could well see this market go to $70 a barrel, because they're all interconnected. This is why we show you all these markets every day, because they are interconnected and they do play off one another. Now, this is an interesting chart. This is the this is the index, the dollar index, and I want to share this with you because we talked about this, and this is why it's important to follow these markets even when they're don't appear to be doing anything. Let me go back to my Illustrator and put this on. And this is what we saw with this market. We felt all along this is a big, what we consider to be a very big energy field. And this was the resistance level right here. So you had the breakout 2 weeks ago. You had the retest of the resistance. This was resistance right here, and now this is turned into support. Okay, resistance turns into support. So the market came back, tested it. We gave it exactly the levels to look at. Is exactly what happened. We came back to 76.06. The market's support was 76.10. So it actually bounced from there. And I think we may see a little bit more regrouping this week, but I think we'll eventually see this market go up to the 80 level. And potentially, let me just draw this across here, the 81 level. Somewhere around there, I think that would not be unheard of. Now, why would that happen when nobody wants to own the dollar or whatever it is? Well, they do want to own the dollar against a basket of currencies, and that's the key thing. I mean, there may be certain currencies that may be stronger than the dollar. Gold may be stronger than the dollar. It doesn't matter. But the reality is the dollar is not collapsing like everybody predicted, and that is what you have to pay attention to. When the market does something that no one's expecting, and this is the dollar going higher, then you have to pay attention to it, because it tells you most of the people, all the people who are betting the dollar was going to go down in this area right here, quite frankly, they're wrong. This is a significant high. You've got a 1, 2, 3, 4, 5-month high, and that's pretty significant. So let's take this off the screen, go to our last market. That's going to be the CRB Index. This is what we track for inflation. And I think you'll be kind of interested to see what's going on there too. So here it is, the CRB Index. Look at our trade triangles right away. Monthly down. Started right here at 335. The market's 329 right now. And the weekly is up, 336. Mixed bag, trading range. Here it is. But look at what we're seeing here. I'm pretty much thinking that inflation is going to kick in somewhere along the line here, but the market's telling you no, it's not going to kick in right at this point in time. Let me close this and get this little more scope here. And you can see how this market has actually, let me get my telestrator on so we can share this with you. You can see how this market basically has just sort of rolled over like this, which is pretty amazing. And potentially we consider this to be a pretty important low right here. So if we take those lows and then we take a look at our Fibonacci tools, and let's just take this off the screen. So we take that off and clear it, and let's take a look at our Fibonacci tools, which is right here. We take the highs right here, scope this down to the lows, which we think it's an important low. So we could potentially see this market come down to the 309 or even the 300 level, which would be, it's not that far away. It's less than 10%, it's about less than 10%. So we could see those levels hit, especially if we see the economy going south. And crude oil, which is an important element into this index, if we go down to $70 a barrel in crude oil, it's potential, I'm not predicting it is, but if it goes down there, then this index will go to 300. So this is Adam Hewison for Market Club. I hope you're going to have a great weekend. I'll be back on Monday at 1 o'clock with the 1 p.m. update. We'll be looking at some interesting markets next week, really interesting markets next week. So please stay tuned. Thank you for watching and have a great weekend.